Every week, the Payne family cuts straight to the real financial story.
The one question, Bob, everyone's asking is, are we in an artificial intelligence bubble? You've been through boom and bust. What do you think?
No hype, no myths. Just what actually matters to your money.
Does feel very similar to what we experienced in the 90s. Where are we, though? Are we in 1995, 1997, 1999?
Listen to the Pain Points of Wealth on the Red Apple Podcast Network.
It's a historically hideous season.
It's our 100th ugly house.
And if these walls could talk.
Do you cry a lot?
I do.
Ugliest House in America season premiere Wednesday at 8 on HGTV.
Good morning. This is Mike Stoller for the Stoller Real Estate Report. What's happening in the multifamily world? A lot of interesting things are taking place. There's a new mayor, so we're going to see different changes going on. There are investors coming from around the world still investing in New York. But today I have a senior guy in the investment sales business, an owner-operator, specifically in the boroughs. I have Lev Mavashev.
Lev Mavashev.
Okay.
Thanks for having me, Michael. Pleasure to be
Lev
back.
is the founder and principal at Alpha Realty.
Thank you. Good morning, Michael.
Good morning. So you were saying it's 17 years. So what's happening? How do you look at right now compared to the beginning when you went into the market?
Oh, it's very different. Well, I actually started in 2009, so I kind of went through the, just coming out of, through the great financial crisis and coming out of it. I would say the market's very different now. If I had to describe it, I would say it's pretty, let's call it selective.
What do you mean by selective?
So there's a lot of capital out there, and even more capital planning to be active in 26, both private and institutional, and foreign, of course. But it's selective, meaning like it's discipline and it's selective where it ends up. Kind of, I would say, depending on the product, right? So multifamily space, there's products within the asset class, anywhere from, your pre-war rent-stabilized building to your newly constructed free market, more core asset type of stuff. So for, let's call it the A products, right? The free market, well-located buildings in Manhattan, especially if it's value add, there's a lot of capital chasing those type of deals. I get those deals I get those deals in a bidding war. I'll have right now we're working on there's a $19 million deal and a $30 million deal where we have over 10 bidders on both of those.
And where are these bidders from?
It's most of it is I would say private equity backed operators, institutional capital definitely chasing those type of deals. Not so much for the foreigners. The foreigners don't like the value add stuff. They like more of the, I would say, turnkey core stabilized cash flow stuff, not rent stabilized as in like market rate rents.
But there's a big interest in the units of 10 or less, correct?
There is a big yes. So it's interesting. Yeah, we've been doing a lot of those type of deals. Last quarter, we're seeing a shift. So transaction wise, we've seen less transactions, but dollar volume, we've seen a surge in dollar volume. It kind of shows that capital's starting to chase the bigger stuff. We are seeing a lot of the trades on the smaller stuff, especially like your typical, I would say 8/2 on the Avenue in Brooklyn, especially if it's free market, right? You have a lot of capital. It's a protected tax class, meaning it's a 2A, 2B. There's a cap on, where taxes could, property tax could increase. So those are getting a lot of interest from both local private investors and institutional capital, like the Carlyles. We all know they build a whole portfolio in Brooklyn out of these buildings. There's definitely a lot of capital chasing those, but I'm seeing more capital chasing the bigger, more quality product right now. So that that's what I meant by selective. Let's call it also markets kind of diverging. You have the A product, which is pretty healthy market for that, and then you have not the B. Let's call it the C product, where there's almost no market for that, and that's your rent stabilized building out in the Bronx or Harlem, whatever. It's tough to get buyers for that type of product right now. There's a handful of guys buying that type of stuff, but if they pass on the deal, then there's almost no bidders for that type of stuff.
What about the 485X program?
Well, it's definitely driving more development. At least from what I'm hearing and seeing, I speak to developers all day. I speak to them more on the other side when they're ready to kind of exit from their development, whether I sell it. Or when they finish the building and they lease it up, they're always debating whether they're going to refinance or sell it. So I get involved in that end of it. But from what I'm hearing and seeing, development sites seem to be pretty active right now. There is a lot of sites that I see trading, a lot of developers chasing deals right now. I'm not sure. I'm not sure if it's spurring this whole development boom that we think it is, but for, let's say, call it these 99-unit buildings, yeah. They're generally...
Why don't you explain what the 99-unit
So,
buildings
generally, 485X, it's a tax abatement that's incentivizing these developers to build, but the minute you go over 100 units and over, you lose. You have wage requirements, right. I joke, a housing incentive bill, it turned out to be a labor bill. But yeah, just to avoid the higher construction costs for building 100 up, mostly due to union wages, developers are trying to keep the buildings 99 units and below. So it's funny. I think we're going to see a city of 99 unit buildings. Maybe one day in the distant future, they're going to wonder. There must have been like a lucky number thing about 99 units because all these new.
So is that what we bet on Lotto or Powerball? Could be.
It's a good bet. Let's try it.
It's a good bet over there. With regard to the boroughs, what's happening in Brooklyn, Queens, Manhattan?
Again, it depends on the product. For the A products, Manhattan, we're seeing a lot of foreign capital coming to the market, and it's not stopping. I know I've seen a little slowdown, I would say, the past few months. In general, we've seen a bit of a slowdown ever since, I would say, June with Mamdani's with Mamdani winning the Democratic candidate. But I think by Labor Day, we were all over it, and we kind of moved on.
So what's your thoughts about Mamdani?
I think he's a good politician. He ran it was a very well-run campaign, and he said the right things at the right time. I think ultimately we are going to see him govern from the center, which is what all mayors have been doing. So I think, look, every I would say every new election year, we kind of have this period of, I don't want to say instability, but hesitation, right? Let's call it the market hesitates. But I think eventually, especially New Yorkers are used to this. New York investors, they, kind of move on, recalibrate and move on. Like New York will,
they're resilient.
They're very resilient. Will adjust and we'll move on. We'll see. We'll see what I think. I think he's going to govern from the center. I don't think we're going to see a big flight of capital from New York City.
What about financing? It's nice to do deals, but is there financing out there?
There's financing out there. The debt markets are they're open. They're open for business. Again, it depends on the product type. But even for rent stabilized stuff, you're seeing lenders out there. It's mostly the regional banks, right? You'll have the Connect Ones, the Santanders. Chase is in that space. They're not giving, their LTVs are anywhere from 50 to 60%. They're conservatively underwriting these type of deals. In general, they are. For the larger, again, the A multifamily stuff, you're seeing, you're seeing agencies are very good rate right now. It's tough.
What is agency rates today?
I've seen with a buy down 4.85%.
That's great.
That's amazing, right? Again, not the small balance agency stuff. The Fannie Freddie larger stuff, you with a buy down, you could hit sub 5. I've seen sub 5. CMBS is if you're into that product, but we did a deal. We closed on a deal last week, 6%. It wasn't even a 10-year; it was a 5-year IO CMBS loan. So the investor was very happy with the debt he got on that deal. But in general, again, depends on the product. But I think the debt markets are, we also have, there's insurance company getting to that space. But I'm seeing all types of lenders.
So as we enter 2026, what's your outlook?
I think we're going to see more activity in 2026. I think now that, I would say, keeping an eye on political clarity, because that's what I think is very important. But I think ultimately macroeconomically, I think it's looking good. think more investors are coming into New York City multifamily. New York City multifamily has proved to be resilient and is attracting a lot of capital. I think we're seeing rates coming down, more debt, more lenders getting active in the debt space, and ultimately the debt markets drive the sales market. So I think we're going to be seeing a lot of activity. I'm not sure if we're going to see an improvement in pricing, but we are going to be seeing more activity.
You'll see some improvement in pricing.
Yes, I think so too.
Slight amount.
Slight amount, and it'll probably take probably into the second or third quarter. We'll see, cap rates compress a bit. But
great. So I know I will see you in 2026. I thank Lev for being here today.
Thank you, Michael. Thanks for having me.
Every week, the Payne family cuts straight to the real financial story.
The one question, Bob, everyone's asking is, are we in an artificial intelligence bubble? You've been through boom and bust. What do you think?
No hype, no myths. Just what actually matters to your money.
Does feel very similar to what we experienced in the 90s. Where are we, though? Are we in 1995, 1997, 1999?
Listen to the Pain Points of Wealth on the Red Apple Podcast Network.